The big news of the morning, Zomato Paytm, and well, a full house out here on the NDTV Profit Studios. Sajid and Harsh join in as usual. Sajid and I will have differing opinions. I don't know what you guys think about every opinion that Sajid gives, but I'll let Sajid and Harsh take over it first. Sajid, over to you.
Okay, so I'm looking from a shareholder's point of view here and how a business is being acquired. If you look at what Zomato is doing, is going to acquire the business of Paytm for 2,048 crores. Let's put it in numbers, and I'm not going by GOVs. GOVs used to be some 10 years ago when Flipkart was the fashion.
GOV is gross order value.
Yes, it used to be something like, big thing in 10 years ago. Now it's based on cash and revenues which you earn. Now you're paying 7 times the revenue and nearly 70 times EBITDA for that business. And at the end of that, what are you going to get? You're going to get 10 million transacting customers, which basically means you're paying 2,000 rupees per customer to acquire them, and you don't know how many of them are unique and how many will transition to your platform as and when it happens 12 months down the line.
And it continues a separate entity, no? They've said
only
this.
for the first 12 months.
First 12 months. After 12 months,
Sajid,
it has to
what
come.
are we comparing this to? How do we know 2,000 is expensive per customer?
So you look at the industry leader here. You have Book My Show, which has been there for more than 15 years now. It's not able to scale up beyond 800 crores in revenues in FY24. So, and Book My Show is a leading, going out app and platform where you get ticketing, you get movies and everything which is there, and it's also getting into other food areas as well as we speak. But point is that 800 crores is the industry leader's revenue, and it has an EBITDA margin of 13%. Your Paytm business has an EBITDA margin of 10%. So there is not much scope which is there for you to expand your EBITDA margin there. So you're basically paying a very high amount to acquire customers, because that's what you're doing. You're not. It's not a business. You're in the business of acquiring customers here, because 10 million transacting customers are there. Okay. And if you had done it organically, you would have spent 300 to 500 rupees per customer for acquisition. And
Sajid, the point out there, and let Harsh take it, but the point out there is that if you do it organically, you are the third person in the race, and you are opening up the Paytm business to be sold to somebody else getting into that business as well.
Before Harsh comes on the Paytm, because Harsh is talking about the Paytm side of the story, I just have a counter to Sajid's point on Zomato. Your concern is, have they overpaid for a business that they could have grown organically? I just want to bring it back to what their track record is with Blinkit, and I have a feeling that, let me just finish. I have a feeling that that's what the market is going to look at. Blinkit came in, or Zomato entered that business after Swiggy Instamart. They turned Blinkit around and they grew it and they scaled up massively. So they've shown a track record of the ability to do it. This is a space where there are only two players largely. Book My Show has a majority share. The upside for this entity in district form in another 12 months is massive, and Zomato has shown the track record and the ability to do it. So in that picture, this 2,000 rupees per customer, you're looking at it as a customer who you're not only going to sell movie tickets to, you're selling everything to. So I think
I think District is a separate app. First of all, it's not a super app which is there.
Correct. It's
and
not a super
Zomato
app
does
like
not follow.
Blinkit. Like Blinkit
like
is.
Swiggy, which has food delivery and Instamart in one.
So I think
that.
investors today are going to look at, and that's what brokerage is also seeing, is also going to look at the track record of the company and their ability to scale
I
up.
get the part of the track record of turning around Blinkit, but Blinkit is still loss making and it just made EBITDA profit in Q1. Okay, so and it will take at least a year or two before it happens.
Paytm Insider anyway. I mean, no one is making money in this business.
The question is that Paytm Insider is a platform and not where you have the same delivery guy doing Blinkit as well as food delivery, which is there, right? So you have the synergies there, and that's how you're making the EBITDA profitability. In this case, it's a platform business which is there.
From the Paytm's point of view, I think there is
just to add one more thing before I go to that.
We have Pankaj Murarka joining in a moment, so we have a minute and a half left.
So the point is that Zomato claims that it has bought the entire business at 1 times GOV, which is a gross order value. But if you go by that as a fair valuation, then Zomato is priced at 4.6 times GOV, which is a high valuation in that sense, right? So what should correct in that? If you
they're
go
different businesses, they're different. I mean, it's not even apples to apples.
The parameter of valuation have been put on by the Zomato management. We haven't put GOV. we are valuing it on revenue.
Going out business and ordering in business are two different businesses. I don't know if you can compare them in that sense. Not even apples to apples.
You're contradicting yourself, Tamanna, by saying that.
No, ability to manage and what you're selling is two different things. Okay, anyway, Harsh.
Just one more point to add on the Zomato piece. We had Book My Show, KKR investing in Book My Show at 7.7 times revenue. This is probably just in FY23. So just in terms of valuation, 7 times versus 7.7. Market leader, Book My Show. 7.7 times, and KKR invested.
So what is the
private
point
transaction.
It was very
I'm just putting it out there that
It's
what's the takeaway? What's
It's a
the
comparable
it's a
valuation.
comparability.
So you're saying this is
That's all.
expensive?
No, he's just laying out the valuations that it's comparable
I'm
valuations.
just laying out
And
valuations.
also, I think what
believe
we
it's
need
expensive,
to
but
be
I mean that's a
mindful of is
personal
while
viewpoint.
this is a very bold move, there is no secret that the high growth phase of food delivery has run its course. And hence the likes of Zomato and Swiggy are putting millions and millions in the quick commerce space. I guess it is just the next leg of growth.
Correct.
But we can of course debate this, but it's great news for Paytm. I think we're
Yes.
all on the same page
Yeah.
when it comes to Paytm.
So I have an easier argument there.
Yeah,
so
you don't have much of an argument, luckily for you.
so it's an easier one. So definitely this is clearly a positive for Paytm. I'm not sure how much of it is priced in because Paytm's up 50% over the last 6 months. So clearly a lot of positivity is already priced in, but of course on a market cap of 36,000 crore now versus the 24,000 crore market cap just about 6 months back. This of course is a significant positive because it's around 8% of revenue, which is solid. In terms of what Paytm has invested in these businesses, that may be relevant because they've invested around 130 crore in net asset value in Obgen Tech, which is one of the subsidiaries which they're going to be selling. Wasteland Entertainment net asset value is roughly 50 crore, so around 180 crore of their own money invested. The other piece is with regard to the couple of other businesses they had acquired in 2017 and 18, Insider and TicketNew. They had acquired both of these for 268 crore. So a cumulative investment roughly of, if I can keep it at 500 crore as a ballpark, and therefore roughly 4 times is what they've made on their investment. So clearly value unlocking playing out. What I am slightly puzzled about is with regard to what they're going to do with the cash, because they have net current assets of roughly 7,000 odd crore.
Right.
Cash plus other assets,
Talking
receivables,
about Harsh, I
etc.
don't know whether you noticed and read the report this morning where the board of directors of Paytm have also capped their salaries. So executive and non-executive directors from 1.65 crores have now said that we will only take 48 lakh rupees home a year. So clearly, I think they're trying to fix the house.
No, they're fixing the house, but they're also trying to figure out what the business model is going to be.
That's true.
But now they have the cash to do it. We have Pankaj Murarka on, so let's just get his view in. We've been all talking about how we see this deal. Pankaj, very good morning to you and great to have you this morning on NDTV Profit on, I think, the big story of the day for the markets undoubtedly. How do you view it? And let's start with the first question we've been talking about. Did Zomato overpay, or is this looking like a good deal?
Good morning to all of you all and your viewers. See, I think it's a very strategic move, deal, and I think it's a win-win for both. Don't look at the deal from a valuation perspective. I think that will be too short-term an approach. I think it's eminent strategic sense for both the companies on both sides. For Paytm as a company which is trying to bring sharper focus on its core business, because they're, let's say, in the payments business, they've lost some market share, they've had regulatory issues. It clearly means that they're letting off one of the businesses which they had seeded and bring much more sharper focus on their core business, which is payments and financial services, including loan distribution, Paytm Money, which is about the securities market business, and insurance distribution. So that's great from their point of view. From a Zomato's point of view, they already have now 2 engines which are firing. The food delivery business, which is on a very strong growth curve, and I think that business will continue to sustain growth momentum for the next decade, though the rate of growth might moderate, but still it will continue to be a high growth business for the next decade. You have Blinkit now, which is growing at a phenomenal rate, and probably in 3 years' time, Blinkit could effectively be the largest retailer in India, overtaking physical retailers who've been around for 20-30 years. And clearly now the idea with this acquisition is they're going to carve this out and their existing dining out business into a separate app called District, which they intend to launch probably in a fortnight's time, and build that as a category. It's an emerging category where Indians or the Gen Z are spending on events and everything else, where they're going to combine all of that, and obviously that business will benefit cross-leverage from Zomato's existing user base. So from a strategic point of view, I think it's a great acquisition for Zomato because over a medium term, over the next 5 years, 10 years, the value of the business can be far, far higher because there's a huge potential. There's a significant incremental spend happening in that category. It allows them to capture that. And from Paytm's point of view, it just reduces one more incremental thing that we're doing because they, over a period of time, they've built so many of those businesses, and in many of those businesses probably are not related to their core business. So it just helps them to bring or double down with a sharper focus on their core business, the payments business, where as it is they are seeing very sharp competition. So I would think it's a win-win for both of them.
Good morning, Neeraj here. Thanks so much. And good to have you in this list of argumentative Indians out here talking about Zomato Paytm. Just one quick thing, Pankaj. So let's assume that the ability to decode whether it is overpaid or no right now, as you said, is a slightly short-term view, and we don't know how it will turn out. If this doesn't work, because Paytm has not been able to combat Book My Show in that fashion, and Zomato therefore entering this category as the second player, right, if you will, and Book My Show has this stranglehold here. If this doesn't work, how big of a damage could it do to Zomato because of the money that it is paid out? Let's say 3 years out, if this doesn't work.
Good question, Neeraj. See, from a financial risk point of view, now the 2,000 crores cash they're paying out is equivalent of 1 year of Zomato's cash flow. Because it's a company which is generating cash. In a couple of years' time, Zomato will be generating 5,000 crores of cash. If I'm not mistaken, in FY27, Zomato is expected to generate 5,000 crores of cash annually. And from there, their cash flows will keep increasing. So Zomato has now become a cash machine. So they're already sitting on about 10,000 crores of cash on their balance sheet. And they're accruing cash every quarter or every day as we go along. So I don't think so that it's a failure of this business will have a significant impact on their balance sheet in that sense. For a company of that size, which is already $30 billion, they need to take meaningful bets to fuel their growth and sustain their growth for longer term. The growth initiatives or the growth bets for a high growth company like Zomato has to have adjacencies with their existing set of business. And I think this business has a very strong adjacency with their existing set of business. More importantly, it will bring some more incremental critical mass to the existing business which is there. And the very fact that they are moving it to a separate app clearly means that you're making this business very strategic and you want to scale this big time. You want to double down on this with a separate dedicated team for the business, carving it out in a separate company and an app, and bring much more sharper focus on the business. On the opportunity set, I think the category is growing and it will emerge as a large category, and it has a room to accommodate a second player. I think, as you rightly said, there is only one player which dominates the space currently, Book My Show. I think the space will definitely have, the industry will have space for one more player. So I think my sense, and Zomato has proven their execution capability. So my personal sense is that they should be able to do a good job in execution and scale this business. In case it were to fail, I don't see it having significant impact on Zomato's balance sheet.
Sajit here. Just a comment from you. Do you think that Ant Financial, which exited partly or more than half of its stake in Zomato, was early to exit because it did not see the strategic intent of the management?
Well, I would not correlate both the issues. I think they're independent. I'm not sure whether Ant has a board seat, so they might not be aware of this impending transaction. But having said that, Ant Financial, for them, it was more a financial investment. They've been investing into the company for last, I think, 9 or 10 years. What I read was, I think they've already made their money 4 or 5x being invested into Zomato. So financial investors will make their exit at some point of time or other. Having made good financial gains, I think they would have thought in their wisdom that it is fair for them to take the money off the table. Having said that, I don't think so. That's a reflection on Zomato's future growth prospects. I think the growth prospects of Zomato continues to remain strong, and which is what also a reflection that the block by Ant, there were more than enough takers for whatever supply was there from Ant in that sense.
One more, the going out business, we've seen Book My Show having the majority stake in that market, but it's still not able to scale up as envisaged, the top line for Book My Show was around 800 crores in FY28, and it's been there for nearly more than a decade now in this business. What Zomato is arguing is that in next 2 to 3 years it will have a 10,000 crores of gross order value, which is there. Do you see this entire segment growing at a very high pace?
See, the way I have seen these internet businesses or new age technology businesses work is you take your bets at an early stage of evolution of an industry or a segment. These are long-run businesses. In 2013 or 14, when Zomato started its food delivery business, I never thought that Zomato will become the top amongst the top 40 companies of India. The fact is today the business is large. It's within visibility that that business will start generating $1 billion of cash flows every year in the next 4 to 5 years. I would have given it a zero chance in 2013 when I first used Zomato app that a company like Zomato can generate $1 billion of cash flow in 5 years' time. India is young. India is changing very fast. Consumers are adopting very fast. The category is certainly out there. All of these emerging categories, they reach a point where you get to an inflection point, and from there you have a J-curve growth or a hockey stick growth, as we call in investing parlance. Some point of time, I think this space will emerge big time, and we'll have hockey stick growth. What is important when you're making strategic investments or business, this thing is to be there, build your platform, and be out there so that when that J-curve growth really plays out, you're out there to capture that growth and establish your dominance in the segment. In that sense, I think the move from Zomato makes imminent sense from a strategic perspective to my mind.
Got it. Pankaj, let me, Harsh also joining in, let me quickly ask you on Paytm, from that perspective, from that lens. You've got roughly 8,000 crore of net current asset currently lying in Paytm, 7 to 8,000. This is now taking literally cash, more cash into the company, arming the company with more cash to probably grow its core businesses. How do you view it from Paytm's perspective?
Harsh, any incremental cash is a good news, but I think the bigger implication for Paytm is they can do with less distraction and more focus. Given that in their core business, which is the payments business, which is the core of Paytm, and they've been trying to build businesses around that, they've seen severe competition where clearly PhonePe and Google Pay have taken market share and built dominant position from Paytm. So it's important for Paytm, and there are many more players trying to get into the payments ecosystem, because all of us know UPI is already $2 trillion of annual transaction value, and it's still growing at a very high rate and probably will keep growing given the strong growth drivers. It's important for Paytm to sharpen their focus on their core business and define what their core is. When it comes to the internet businesses, the customers are very demanding. They don't like to get distracted, and because the customers are so demanding, it's very important for businesses to succeed. For businesses to succeed, to be very sharply focused on what they stand for, what value proposition they're offering to customers, and bring a very sharp value proposition to the customers. So in that sense, I think in the new strategy which Paytm is trying to build its business, it's very clear that they want to focus on payments and they want to focus on financial services. They had at one point of time designs or thoughts of doing Paytm Mall and all of that, but I think now in the new scheme of things or in the rework strategy, all of that is clearly taking a backseat, and I think it's wisely so. So I think while any cash is good, and from Paytm's point of view, from where they bought this business, they've scaled it meaningfully in the last 6 years, 7 years, and made handsome profits out of it. But I think the bigger thing is it will help them focus more sharply on their core business, which is financial services, and double down their resources on that business rather than trying to do everything under the sun.
All right. Okay, thank you so much for that, Pankaj Murarka. That is going to be an exciting morning. Just before we go into that break, I just want to pull up a compilation of what most brokerage houses are saying, and most of them are fairly bullish. Yeah.